So today's topic of discussion is, are markets overheated? We will take a look at a ratio which may guide us going forward. But before we go ahead, please do like and share this video and do subscribe to the channel if you haven't so far. So every time the markets are close to a new high, we will hear this famous familiar discussions whether markets are overheated. Should I withdraw my money? Should I add money or not? Should you even pay attention to these discussions or narratives? The Indian market has seen significant growth in the past 2 decades, and when we see this 30-year chart, we see that there are only 6 down years in the last 26 years, of which 2 are of virtually no significance, and only 4 down years in the last 26 years. Now, how big is the India stock market compared to its economy? So this question is there because a lot of folks consider stock market to be really reflecting what is happening in the economy, but which may not be the case. They may be completely in sync sometimes and completely out of sync sometimes. So is the market expanding in line with the economy or getting ahead of itself is the question. And does it really matter? So let's look at this ratio chart, CNX 500 to the Indian GDP. What this ratio is going to tell us is it will help us identify major turning points in the market cycles. It will show periods where the market's momentum accelerates or stalls. It reveals how external shocks or global events impact the markets relative to the economy. And it is useful to spot structural shifts that may be fueling long-term trends. So this is the chart of the last 25 years, CNX 500 divided by the GDP of India. And every time you are seeing that, this GDP, this CNX 500 to GDP hits this upper band or more, it is a sign of some sort of overheating, and it comes back, and the lower band is where the safe zone is there, where it becomes that the market is much much far behind the GDP when the lower band is there. And when the upper band is there, basically it says that the market is sort of ahead of itself. So we are here neither at the upper band nor at the lower band, but near the upper band. And let's also look at the past downward phases. So phase one was Feb 2000 to September 2001. It lasted for 18 months, and there was a 67% drawdown on this. Phase B was the GFC crisis, where you had a 14-month duration of 60% down. And phase C was September 10 to August 13, duration of 35 months, where it was down 15%. Let's now also look at the upward phases. So 01 to 07, we had 6 years, where the returns were 822%. Phase B was post-COVID, where you had November 08 to October 10, 2 years, where returns were 184%. And phase three was post-COVID, where for 1.5 years, returns were 155. And you can see they are all lining up. The start of that is lining up towards the bottom of that phase. So where can this ratio go? Basically, either it will go up, or it will stay flat, or it will come down. These are the only three scenarios that are possible. So if the ratio breaks out higher, for instance, let's hypothesize, then the possible drivers could be the global risk on sentiment may be there. Maybe the Fed cuts 3% as Mr. Trump wants, and India decouples, and the narrative builds, and domestic real estate participation also picks up more steam, and FIIs who have been sort of flattish in the last month began to buy in a big way. Higher multiple expansion may happen with low global rates, and strong earning expectation may come with the strong money inflow and weak GDP growth while markets stay high. So this INR depreciation slower than market growth also can help in that money coming through. The second scenario that we could think of is perhaps we'll just consolidate here and stay here. So basically, CNX 500 will limbo around in line with the GDP. So if GDP is growing at 6-7%, then we are also pretty much in line there, maybe a percent two or two here or there. So no significant valuation change, and balanced capital flow, no major surges, no major exits. In the INR also stable the way it has been going. The third scenario, of course, is that the ratio drops sharply, and it will drop sharply in the case of when there's a broader market sell-off, maybe due to global risk off, maybe due to other reasons, while the economy still may be doing all right. So interest rates may get hiked, domestic policy shocks may be there, valuation derating may be there, but while the GDP is still in decent flow. So GDP is then in that case growing faster than the market, sharp INR depreciation may happen, corporate earnings may disappoint, and global financial crisis or geopolitical shocks may happen. So These are the three scenarios that we can think of now. Can you afford to exit now because it is nearer to the top band, or you think that it is overheated, or this band has not been broken since 2011 and hence it is likely to go down? Not really. I mean, you can't really base your decision on that. So the idea here is to know and to anticipate things, but do price action following for your decision making. So, if this ratio shoots up despite all odds, can you handle that FOMO if you were sitting out? You can't, right? So markets may be irrational, and that is where simply following price instead of history based forecasts may be more useful. So tell us in the comments, would you like to see various other ratio charts similar to this? How would you like to see the next ratio chart? How to yeah, find insights into that? And we also did a very nice video on the nifty dollar correlation. Do watch it if you have interest to find that correlation. And overall would like to re-emphasize that while studying macros, studying the global makeup is good, you should always be aware of it. It conditions your mind that even if you are following price, you'll be able to not take it like a shock in terms of your decision making. That's how it is going to help you. And of course, do like and share these videos, keep watching these videos, do subscribe to the channel, and do share it with your loved ones. Thanks. Bye.